let's get started. I wanted to talk to you today about how nonprofit accounting is different than for-profit accounting. The major difference is nonprofits do not have owners. Nonprofits are not in the industry to have a profit. They don't have a profit motive, and they don't pay income tax. We do have boards of directors that are in charge of our governance and our accountability. So we also have other stakeholders, for example, donors who want to compare organizations. So we have rules that are very different from for-profit accounting in order to satisfy all those needs. Now, having been granted tax-exempt status, we've gotten that status because we're out there to promote the public good. The types of nonprofit organizations, I just want to go over them very quickly. Public charities for charitable, religious, and educational purposes. Private foundations are very similar, but they generally have one major donor. And then there's other nonprofits that promote public good through social welfare, civic leagues, social clubs, and business leagues. For these organizations, the generally accepted accounting principles are different. What we're trying to do is demonstrate compliance with our tax-exempt purpose and show that we are promoting the public good and that we can be trusted. So there's three major areas of differences in accounting for nonprofits, and I want to talk about each one separately. The first one is net assets. Like for-profit entities, net assets is like their equity section. It's basically the difference between the assets and the liabilities, and that's all it is. But there is more to it than just the difference between the assets and the liabilities. We have complicated structures. We have restrictions and endowments and designations that we have to track. So let's go over these different types of things that we have to track as part of our net assets. We have endowments that expand over multiple years, even decades, where the corpus of the money has to be kept in perpetuity. And the investment earnings from year to year are earmarked usually for programs or for operations. Sometimes some of it has to be plowed back into the corpus so that it grows. So these complications have to be tracked in the net asset section. Another area of net assets is our restricted funds. Now, these are funds restricted by the donor, and they're usually restricted for a specific purpose or for a specific time period. So we have to track the balance of those funds until they're used up. This could be over multiple years. Now, this is where a lot of our grants come in, or major donors give a gift for a capital campaign or something like that. That's the kind of things that we're talking about where it's donor restricted. The third type of category that we need to track in our net assets is designations. Now, these are not restricted by the donor. Generally, this is the board of directors saying, we have this purpose, we want to set aside this money for. And because it's designated usually by the board, whoever designates it can undesignate it. So it's not considered a restricted fund. It's part of our unrestricted money, but we have to track those designations. A perfect example of a designated fund is a savings for reserve. So that's the easiest way to think about it. And then, of course, our fourth section is our unrestricted or operating net assets. Those are available to be used in our day-to-day operations. The second area that I want to talk about is revenue recognition. Now, for-profit entities tend to follow a matching principle where they're trying to match the income earned with the expense incurred that it took to earn that income. So they're trying to match the dollars in with the dollars out so they really know what their true profit is. For nonprofit entities, that's different. In the past, we've looked at all of our contributions as just that, contributions. Do we have restrictions on them? Did those restrictions cause us to delay the recognition of the revenue? FASB has come down with some very significant changes, maybe about 5 years ago, to talk about what is truly a contribution and when is it recognized, and when is there an exchange transaction, and how is that recognized. So nonprofits have two types of revenue and two ways to recognize revenue. Contributions, which are generally cash, non-cash, things where there is no expectation by the donor to receive something in return. It's a non-reciprocal agreement where they give us the money, they may expect us to spend it on somebody else or something else, but they don't get anything in return for that. Those are considered contributions. They can be conditional or non-conditional, and they are recognized basically when received or even legally enforceable. So if you have something in writing, you can recognize it and set up a receivable. I want to try to share a slide with you. We will put these slides in the comment sections. The first slide that I wanted to go over kind of delineates what is a contribution and what is an exchange contract. A contribution is truly a cash transaction or non-cash transaction where, like I said, there's no reciprocal agreements. These can be grants, these can be rental income, reimbursements, guarantees, and non-monetary exchanges. Where we have the exchange transaction is items like tuition and fees, membership dues, perfect example, sponsorship revenue, royalty or licensing or program fees. Now these can all be exchange transactions and have to be recognized in a different way. But first let's talk about contributions and how they're recognized. Generally, the contribution is recognized when received or legally enforceable, as I've mentioned before. There are some contributions that are conditional. So we may have to wait until the conditions are met before we can recognize the revenue. That's a pretty simple way of doing it. In our exchange transactions, there are 5 steps that we have to follow. And the slide that we're going to post in the comment section is going to do a very good job of helping you follow this. So you may want to rewatch this part of the video when you get the slides. Exchange contracts are something where we receive funds or compensation of some sort in exchange for some sort of performance obligation. What we have to do is we have 5 steps that we have to follow, and they are basically, the first step is to identify that there is an exchange contract and who the customer is. The second step is to identify what performance obligations we are required to do in order to receive that price, that money. Once we've determined what those obligations are, we have to assign a value to them. We then look at the entire contract and all the performance obligations and all the values, and we compare that to the money that we've received. And we recognize the revenue in the same way that those performance obligations are completed. A perfect example is membership dues, and I want to run you through it. So let's say we're an organization that has 2 events a year and a monthly newsletter. That's our only performance obligations to our members. Our members are allowed to attend this educational event, say we have them in April and October. And the value that we're going to assign to those events that we give to our members is $1,000 each. In our monthly newsletter, let's assign it a value of $50 a month or $600 a year. So we have a total of $2,600 of performance obligations that we have to meet. So to make this example really simple, let's say our membership dues is $2,600 a year. We are going to recognize that membership dues in the months where we perform the performance obligations. So in April and October, when we have our events, we get to recognize $1,000 for the event and $50 for the newsletter. So each month, we're going to recognize $1,050 for April and October. All the rest of the months, we're going to recognize $50 of membership dues revenue, bringing us to our total of $2,600 for the year. I know that was a little complicated to follow, but I want you to continue with that example. Let's say our dues was $3,000 instead of $2,600. Our performance obligations, the values are still the same. So now we've got $400 of excess membership dues. According to GAAP, that is a contribution, and that $400 of excess is recognized according to the contribution rules, generally immediately when received. So that first month, we're going to recognize $400 as a contribution, and then the remaining $2,600 is going to be recognized as we described before. I know that's really complicated, and I'm hoping that the slides will make it easier for you when you see them. Now, the last thing in nonprofit versus for-profit accounting that's extremely different is allocation of expenditures. We need to be allocating our expenditures to all areas of our programs and operations. A great example is staffing, especially our executive directors who wear many hats. Many times they are doing fundraising events, they are managing the entire team, and they are in charge of our programs. So we need to be allocating their expenses, their office, their computer, that kind of stuff to everything, not just administrative in general. And how we do that methodology and how often we apply those allocation methodologies has a significant impact on our reporting. We need to make sure that those methodologies and the timing is reasonable, and we're allocating the proper amounts to administrative, fundraising, and program, at least for our 990s. So we need to be looking at things, for example, when it's staffing time, is how are people spending their time? Are we going to give them a time budget, and are we going to allocate time that way? Let's say our executive director needs to be spending, 30% in fundraising, 20% in administration, and 50% in programs. Hope that's 100, yes. So all of the compensation, all the expenses related to that executive director is going to get split that way. Whether we do that per pay period, monthly, quarterly, annually, that depends on our accounting system and what is the most efficient way to handle that. So those are the three main areas. While much of nonprofit accounting and for-profit accounting are the same, we really need to be looking at how we're tracking our net assets, how we're recognizing revenue, and how we are allocating expenses to our various programs and grants. And sometimes this happens over multiple years that we're tracking this stuff. We recommend that your accounting team has access to expertise in all these areas. The proper recording of transactions of these types can have a significant impact on your reporting for internal and external purposes. They also affect your ability to manage your cash flow and raise funds for your organization. I want to thank you for joining us today, and remember, creating a bigger impact starts with stopping the headaches. If you're dealing with headaches in your nonprofit organization, we'd love to help you cut through the noise.